last topic of accounts book writing is the finalization. Let us see how to finalize these accounts now. To finalize the account, the first entry is an outstanding. You have to find out the list of all the expenses which are outstanding, which will go to the next year. This is not which is not payable for this year, but it will be payable in the next year. Okay, for example, we can say one is what salary statement. This all this outstanding, assume that this salary statement is of March, but this all this PF, ESI and everything which is payable in the next year. So all this you have to pass this entry as a journal entry on the 31st of March. Okay, so how to pass those entries in journal? So I'll go to the journal entry, journal on 31st of March. This is the first entry. Okay, so here you have to enter. So first is from salary statement, that is ESI payable. So ESI account debit, ESI employee. This entry we have done already. Employee ESI, employee ESI account. Date should be, remember, 31st of March. So employee ESI 15/6/32, 15/6/32. Credit what? ESI employee payable. Similarly, employer ESI, employer ESI, employer ESI employer. That is, first you have to put indirect expenses, remember. Okay, and second is payable, ESI payable employer is this, that is 2534, 534, and credit will be ESI payable. This is all provisions. Okay, so this is the way. Even TDS also, PF also, employer and employee PF you have to put, and TDS also. TDS on salary account debit, TDS on salary account debit, TDS on salary, TDS on salary, indirect expenses. Okay, that is, this is the net salary. You have to take it from here. Assume that this is, say, 50,000. I'm just entering, we already not calculated here. 50,000. So employees TDS on salary is this 3833. TDS on salary 3833. Credit what? TDS on salary payable. Okay, this becomes a provisions. Similarly, this PF also, ESI, and even net salary also, salary payable, salary account debit, that is 50,000, and this is salary what? Payable. Salary is an indirect expenses, this payable. Suppose even this is relating to your salary statement. Suppose you are paying rent also. This every month you are paying the rent. Rent of this month will be paid, and assume that the rent you are paying, say 40,000 rent you are paying. Okay, this March rent will be payable in the next year, but you have to show this year on 31st of March. Rent account debit, it's already there. Rent account debit, how much is payable? 40,000. Credit rent payable. Okay, similarly, audit fee, remember, this is very important. This is fee. Basically, the CA is doing audit on 31st of March, but the bills we will be receiving from CA after 31st of March. But in March, we have to, suppose the CA is charging 1 lakh as an audit fee. Okay, so because this is the audit of 31st of March, remember, of the last year, but this amount which we will be paying what? Next year, but this year we have to show as an audit. So you can show here, say, audit fee, audit fees. This is indirect expenses, 1 lakh. Credit audit fees payable, provision. Okay, okay, like that. Similarly, suppose there is okay, this is the one entry what you have to do on 31st of March. Similarly, there are other entries also. I'll explain you. This is one outstanding entry what I have explained you. Remember, you have to collect all outstanding, whatever is paid. Suppose a telephone bill is there, pass the entry, telephone bill account debit to outstanding telephone bill, or a telephone bill payable. electricity bill account debit to electricity bill payable or a outstanding electricity bill. One is the expense account, second is a provision. Okay. So this is the first entry you have to do as a finalization of account. Second is a credit balance and debit balances. I'll explain you about debit balance, credit balance of debtors in balance sheet and a debit balance of debtors in balance sheet. Now sometime if you go to the balance sheet here, if I go to the balance sheet, sometime you will find in debtors, see all the balances, whenever it's a debtor, remember, all the balances should come on debit side. All the balances should display on the debit side. That's why it is called debtors. In some account, if it is shown on the credit side, this side, that means those amount are paid in advance to the debtors. Remember. Now I'll just show you one entry. Suppose the advance is paid to someone. I'll go to the payment entry, or suppose I received the advance from someone. Okay. Now suppose I'm selling the computer and all. Suppose I don't have a computer right now. So customer is ordering a particular item, but that item is not available with me. So I'm requesting him to pay some advance. I will give the item after 5-6 days. So I didn't sell the goods, but I'm receiving the money in advance from that party. That is called advance received. So you can put here, whenever you are receiving the advance from the party, you create a debtor here. Or see, suppose I received advance from Mr. John. Say Mr. John, say dice. I received as this is sundry data. Okay, say about 10,000 I received in advance from Mr. John Dice, and debit what? State Bank of India. Our bank account, remember. Okay. So I received in advance from John Dice. At that time, if I see the balance sheet, and in the debtor side, the John Dice will show on the credit side because I have received in advance. Now tomorrow, suppose I sold the goods to John Dice, I'll pass what? Sales transaction. Debit what? Say John Dice. John Dice sales, say 12%, say about 15,000. Output CGST. Output SGST. 10,000 I have received in advance. Now if I see the balance sheet, now of John Dice and the data, it will show me, see, John Dice, there is a John Dice. Now see, 6,800 is we have to receive from John. See, if I'll press enter here, I'll press enter. See, we have received in 10,000 from the John Dice, and the goods are sold what? Of what? 15,000 so and so. We have received this in advance. So how much we have to total receive from the this John Dice? 6,800 is we have to receive from John Dice. Okay. What I mean to say is, whenever we are receiving in advance from the party, you pass what? Received entry, and when the goods are sold to the party, you pass sales entry for the party. Okay. Now at the end of the financial year, suppose I have received some advance from the party. All these are advance. Say 80,000. Anthony Fernandez, and then there is Mahesh Kamath. Anthony Fernandez 89,600, Mahesh Kamath 61,564. Okay, so at the end of the financial year, I'll pass the entry. Okay, journal entry, say 31st of March. Okay, all the debit, I'll say all the credit balances of the data, I'll say debit. So Anthony Fernandez. So that is 89,600, okay, and again I'll say debit. What is that? Mahesh or something. Mahesh Kamath 61,564, okay, and this is what you have to put this under. You can create some data, debit the data and credit advance from data as a current liability. So I'll go to the Excel, okay, and here advance from data, current liability. Remember, this is very, very important. Okay, so this is one entry. See, vice versa in the creditor also, actually in the creditors it should show credit balance, and if it is in the creditor shows the debit balance. I'll go to the balance sheet and see Now see, in the balance sheet all will be a debit balance. There is no credit balance, because credit balance, whatever credit side it shows the party in balance in the journal entry, I debited them, and credit will be advanced from debtors as a current liability. Similarly, for sundry creditors, if the creditor shows the debit balance, when the creditor will show the debit balance, if suppose we paid something to the creditor in advance. Now suppose I paid rupees say 15,000 in advance to Mr. say Mr. Peter Fernandez, and here advance say Peter Fernandez. So sundry what creditor, I paid rupees 15,000 to Peter, and from State Bank of India or a cash, whatever. Okay, State Bank of India. Okay, now see, if I see the creditor here, see the credit balance will show credit balance. Remember, when the creditor shows the debit balance, that means either that entry is a wrong entry or it is paid in advance. Remember, vice versa the debtor, if the debtor shows the credit balance, that means either that entry is a wrong or it is received in advance. Here it is paid in advance, rupees 15,000. When it is paid in advance, you have to debit what? Prepaid to supplier. I'll give this entry in writing. So at the end of the financial year, if the creditor shows the debit balance, so you have to pass the journal entry. Remember, all the dates are on 31st of March. So 31st of March, okay, prepaid to supplier under what? Current asset. Remember, current asset, that is say for example say total how much, 15,000 it was, 15,000, and credit what? That party Peter Fernandez. That's it. Okay, if some other parties are there, you have to add all those party credit from all the parties. Okay, so now if I go to the balance sheet, now it will show what? All the creditors will show credit balance. There is no debit balance for the creditors. Okay, so this is what second entry what you have to learn. So first entry is outstanding, second entry is a adjustment of your debtors and creditors from the balance sheet. Okay, topic which is very important when we finalize the account is depreciation on the fixed assets. Okay, these are the rates of depreciation. You have to note down these rates. Always furniture 10%, machinery 15%, vehicle 15%, computer 40%, office equipment 15%. Okay, so these are the rates of depreciation, but depreciation we are calculating at the end of financial year. Okay, now here this is very important. Here one note I have given here: any asset which is purchased before, see, any asset, this note is very important here, any asset which is purchased before 30th of September, we are calculating full depreciation. Full depreciation, these are the rates. Okay, if any asset is purchased after 31st of September, this half the rate, means what? This is right now 10%, it will be 5%, 15%, it will be 7.5, like half the rate of this, if any asset is purchased after 30th of September. So I'll go to the tally and I'll pass some transactions here before explaining you. Assume that I have purchased some asset. When we purchase the asset, we pass the payment entry. First we pass the journal entry for the bill. Say debit what? Computer. Suppose I'll put the date here, 1st of April. Suppose I purchase some computer on 1st of April. Okay, say debit what? Computer account. This is not purchased to sell it, but it is for office use. So debit will be computer account, say about 25,000. If there is a GST on the bill, you have to put what? Debit input CGST, SGST. I will not put that. So credit what? RT. I purchase that from Jameson Computer. Okay, sundry creditor. Done. Okay. Okay. Suppose I purchase another computer, one more computer in June, say 1st of June. I'll put June. Say again what? Computer account debit. I'll put say 40,000 here. I purchase one more computer from Jameson Computer. Okay. Again in say I purchase one more computer in say November. In November, say as a computer account debit under say about 35,000, say Gemson Enterprises. Okay. Similarly, suppose I purchase some furniture on say 1st of say May, say furniture account debit. It's already there. If the ledger is not there, you have to create it. 12,000 debit what say Shahu Marketing. You give any name to the party. I'll just pass the bills. Okay. Similarly, suppose again I purchase some furniture in 1st of what say December. Say furniture account debit. Say about worth of 10,000. Say Shahu Marketing. Okay. Similarly, I purchase one car. Say car account debit. Say in say 1st of say December only. 1st of December I purchase one car account debit. It's not there. Car account debit under what? Fixed assets worth of 5 lakh. And credit what? Say I'll just pass the payment directly because there is no party for here. So car account debit, I purchase a credit what? State Bank of India. Okay. So these are the assets what we have purchased. Even suppose we purchase one machinery also. So I'll pass the journal entry for the machinery. I purchase a machinery, say machinery account debit under what? Indirect, fixed assets. Under fixed assets. I'm not entering GST part. Say machinery of say 5 lakh. And credit what? Say from which company? Say XYZ company. Sundry creditors. So these are the entries I have already passed in account during the financial year. At the end of the financial year, we prepare what? Depreciation. We calculate depreciation. To calculate depreciation, let us go to the balance sheet now. I'll go to the balance sheet. Detail about the balance sheet. I'll click on detail here. See, these are the fixed assets. What we have? Car, we have computer, we have furniture, machinery, and why that Shahu Marketing is here. I'll just press Control Enter here. He is actually sundry creditor, not fixed assets. Okay. So there is a car, computer, furniture, and machinery. These are the assets what we have. So I'll go to the Excel and calculate the depreciation on the assets. Okay. Let us take the depreciation on car. I'll just put here. You have to prepare this depreciation also. This report you have to prepare in Excel. This is assets. First is what we'll put car. Okay. Okay. And here you have to make say the column before SEPT September. I'll put first opening balance before September, after September, depreciation, and the return down value. So these are the columns you have to prepare for depreciation. First, let us calculate the depreciation of car. So I'll go to the car, go to the balance sheet here, detail about the balance sheet, put the period here, 1st of April to 31st of March. Period is very important. 1st of April to 31st of March. Okay, open the car account, enter. See the car here. Car is purchased in December. Worth of what? 5 lakh. There is no value on top. So the car is purchased in December worth of 5 lakh. Okay. Now as per this TDS, car is a vehicle. Okay, there is a 15% GST. This one is a depreciation is there on the car. 15% GST depreciation. So important thing is, see, to calculate depreciation, first go to the balance sheet, fixed asset. I want to calculate the depreciation on car. Press enter on car here. See, the car is purchased in December. That is what? After September. This is purchased after September. When any asset is purchased after September, we have to calculate what? Full half depreciation, half the rate. Okay. Now, what is the rate of depreciation here? What is the rate of depreciation on vehicle? 15%. Okay. Car value is what? 5 lakh. Okay. So I will calculate what? 7.5% on the half the rate. So depreciation is 37,500. Okay, so I'll put it here only in this table. Car opening balance is 0 because here as per this there is no opening balances here, 0. There is no opening balances. Before purchase there is no before September nothing is there. Before September this is also 0. After September is what, 5 lakh. Depreciation on this directly half the rate into 7.5%, half the rate. Return down value will be what? Opening balance plus purchases before value plus after value minus depreciation is a return down value. Okay. Second, now I'll calculate the computer now. See the computer. This is the September month of September. This is purchased before and this is purchased what? After. Whatever is purchased before, that is total. You calculate the total of this. It becomes what? 65,000. On 65,000, I'll write it here on my table. Say computer. I'll calculate now computer. Before value, opening balance is not there. So I'll not use the opening balance. After, before, this is 0. This before value is 65,000. After value is what? 35,000. Okay. So depreciation I will calculate here. On 65,000 I will calculate. See the on computer depreciation is 40%. Okay, on computer depreciation 40%. So on before value I will calculate 40%, and on after value I will calculate what? 20%, half the rate. So total depreciation becomes 26 plus 7, that is what? 33,000. So total depreciation I'll type here 33,000. This I'll remove. Okay, understood how to do? Before value full percentage, after value after September half the rate. So total depreciation is what? Return down value becomes opening balance plus before value plus after value minus depreciation is return down value. So next one, I'll go to the tally. Next one we have furniture. Furniture September. Again in September there is what? 20 this is 27,000 is before value and 10,000 after value. So furniture I'll just increase the size so that you can see it more better. So on furniture there is opening balance is not there. Okay, so if there is opening balance here also, you have to put the opening balance. There is opening balance here on top. Remember, opening balance means previous year data. Okay, you have to put that there. Before value, I'll just put it here just to explain you. Before value is what? 27,000. Then after value is 10,000. Okay, so depreciation on furniture on this is what? Furniture depreciation on furniture is 15%, sorry 10%. So what I'll do now, how you will find it out. So before value and opening balance you add, and on this you find out 10%. Okay, and whatever after value is there, that is 10,000, you find out what? 5%, that is half the rate. So total depreciation becomes this plus this, that is 4,200. That's total depreciation. Okay, so this opening balance and before value you add and calculate full depreciation on this, and after September only half the rate. Okay, yeah, so this is return down value is, so this plus this minus this depreciation. Okay, now what is left now? Machinery, that is purchased in December, that is after September, that is 5 lakh. Machinery, okay, this is 0, after is 5 lakh. On machinery there is 15% depreciation. On machinery there is a 15% depreciation, machinery 15% depreciation. So I will do here 15% depreciation after is what? 15 minutes, 7.5% depreciation. So return down value is this minus this. Okay, now suppose any asset. Now for example, suppose I purchase, I'll just pass one more entry. Suppose I brought one more vehicle, suppose I purchase some, say, Xerox machine. Say directly I'll pass the payment for that. You can pass it. Xerox machine. Okay. Under what? Fixed assets. Say about 10,000. Say about 50,000. Okay. And say cash. I paid by cash. Okay. And during the year, say that machinery is that Xerox machine is sold. It becomes old and we sold that and we received money. So I'll pass a receipt for that. Say Xerox machine is sold. Okay, for what? 30,000 we have sold it. Okay, and say debit what? Say we have received the cash. It is sold for 30,000. Okay, when I go to the machinery here, Xerox machine, see the 20,000. When I press enter here, okay, see here it shows we bought the Xerox machine. And just I'll change the date of the receipt here. Say 1st of March we sold that. Okay, now see here, Xerox machine is purchase of 50,000, that is credited, means sold of 30,000. There is no, right now at present there is no Xerox machine for in the business. Remember, whatever Xerox machine was there, we have already sold that. That means that machinery, that Xerox machine is not there with us. In this case, see, to find out the depreciation, first of all, that asset should be there in the business. But that Xerox machine is not there in the business, it is sold. Okay, in this case, we have to find out whether it is a profit or a loss here. So we have purchased for 50,000, we sold it for 30,000. 20,000 is a loss on the sale of this asset. So I will not find out the depreciation in case of Xerox machine, but in account I'll pass the entry on 31st of March, journal entry on 31st of March, loss on sale of asset under indirect expenses, remember. Okay, that is of 30,000 is a loss, 20,000 is a loss, and credit what? Xerox machine. That's it. Okay, so this is the way you have to prepare the depreciation report. Okay, and after preparing the depreciation report, we have to pass a journal entry for depreciation. This depreciation, total depreciation is how much? This is the total depreciation, 1,12,200 is the total depreciation. Pass the journal entry on 31st of March, debit depreciation under indirect expenses. Okay, 1,12,200, 1,12,200. Credit all the assets, that is a car. On car there is a depreciation of what? 37,500. On second is a computer. Credit what? Computer. On computer there is 33,000 depreciation. Credit then furniture we have 4,200 depreciation, and then machinery we have 37,500. That's it. So depreciation as on 31st of March, this entry you have to pass. So to enter the closing stock of this year, this financial year, you go to the accounts information. Now assume you're this financial year, at the end of this current financial year, it is showing what 5,20,000 as a closing stock. Okay, closing stock, assume that 5,20,000 is your closing stock as on 31st of March 2021, assume. Okay, to enter this, to pass this entry of closing stock, what you do, go to the balance sheet, detail about the balance sheet, then go to the closing stock, enter, and alter this ledger, control enter this ledger, and here this is the closing opening balance of the previous year. Okay, now to enter the closing stock closings, this is the closing stock of the previous year. To enter the closing stock of this financial year, you have to just put here closing balance, that is what, how much, 5,20,000. okay, sorry, 31st of March 2021. okay, the amount is 5,20,000. That's it. You don't have to pass any entry for that. Just alter your opening stock ledger. Either you can alter it from the balance sheet directly, or you can even go to the what, accounts information, ledger, alter. Opening stock ledger you alter, and here you have to just put what figure of the 31st. You have to put the date here, 31st of March, and put the figure of the closing stock. That's it. Okay, and if I go to the balance sheet now, okay, and say detail and put the period here, 1st of April to 31st of March, you will see the closing stock is what, 5,20,000 of this end of the year. Okay,